Hey everyone, and welcome back to the Safe, Simple, Sound podcast, where we take the complexity out of finance so you can take control. I'm your host, Alex, and I'm glad you're here. Today, we are tackling a decision that every single new business owner, freelancer, and sole proprietor has to make, a choice that sets the entire financial tone for your business. We're talking about choosing your business accounting methods. Making this choice correctly is a perfect example of what we stand for here at Safe Simple Sound. It's about understanding financial choices to seize financial control right from day one. By the end of this episode, you'll have a clear, simple, and sound understanding of one of the most important financial decisions you'll make when starting your business. Ready to build a strong foundation? Let's dive in. Today, we're starting with what might sound like a dry, boring topic, but I promise you, it is one of the most important decisions you'll make. We're talking about your business accounting methods. Now, when you hear that phrase, you might picture a stuffy accountant's office, but I want you to reframe that. Think of this less as a personal preference, like choosing between coffee or tea, and more like choosing the fundamental operating system for your business's financial world. Are you building on Mac OS or Windows? Because the choice you make will dictate how everything else runs. And this isn't just a theoretical choice. This is a formal, official decision you lock in on your very first business tax return. That's right. It's a line on a form that sets the financial tone for your entire business. So, what are the options? For most new ventures, it boils down to two main choices, two paths you can take. You've probably heard the terms, the cash method and the accrual method, or you might hear them called cash basis accounting and accrual basis accounting. We're going to get into the nitty-gritty of cash versus accrual accounting in our next segment, but for now, just know these are the two main doors. And here's why this is such a big deal. For anyone just starting out, this decision ripples through everything. This isn't just paperwork for the IRS. This single choice directly impacts three critical areas of your business. First, your daily bookkeeping for your small business. It determines the answer to a simple question. When I make a sale or get a bill, when do I actually record it? Do I do it when I send the invoice or when the money actually hits my bank account? Your accounting method is the rule book for that. Second, your year-end taxes. The method you choose directly affects when income is considered earned in the eyes of the IRS, which, as you can imagine, has a massive impact on your tax bill for any given year. And third, and this is the one people often forget, it shapes the financial story your business tells the world. If you go to a bank for a loan or try to attract an investor, the story told by accrual basis accounting can look very different from the one told by the cash method. It's the language your numbers speak. Honestly, understanding the difference between these accounting methods is one of the most powerful foundational steps you can take to gain real control over your finances from day one. Getting a grip on this is fundamental to good small business accounting. It's how you go from feeling reactive and stressed about your money to feeling proactive and in command. So to recap, your accounting method isn't just a preference, it's a formal set of rules you select on your first tax return. The two most common choices are cash and accrual, and that one decision will define your daily bookkeeping, your taxes, and the financial story you tell. All right, that brings us to your call to action for this segment. Before we jump into our next topic, I want you to do a little bit of thinking. It's a simple exercise. Just reflect on your business operations. Do you typically get paid immediately when you provide a service or sell a product, like a coffee shop or a retail store? Or do you do the work, send an invoice, and then wait a few weeks or even a month for the payment to come through, like a freelance designer or a consultant? Really think about that, because your answer to that question is the key that will unlock which accounting method is likely the better fit for you. We're now doing a practical comparison of the two heavyweights in small business accounting, cash versus accrual accounting. Let's break down what they are, and more importantly, what they mean for you. First up, let's talk about cash basis accounting. This is the one that feels the most intuitive for most people starting out. Honestly, it's probably how you already think about money. The rule is incredibly simple. You record income when the cash actually hits your bank account, and you record an expense when the cash actually leaves it. Money in, money out. Think of it like your personal checking account. You don't consider your paycheck earned until it's deposited, right? And you don't count a bill as paid until you see the money withdrawn. That's cash basis in a nutshell. So let's use a real-world example to make this stick. Imagine you're a freelance graphic designer. You do a big project for a client and finish it up on December 20th. You send the invoice that same day, feeling great about ending the year on a high note. But your client is busy with the holidays and doesn't actually pay you until January 15th. Under the cash basis accounting method, even though you did the work in December, that income doesn't count until January. It belongs to the new year because that's when the money physically arrived. For your bookkeeping for small business, this is straightforward and easy to track. Now let's look at the other side of the coin, accrual basis accounting. If cash basis is about cash flow, accrual basis is about performance. It gives a more formal and arguably more accurate picture of your business's health. With the accrual method, you record income when you've earned it, and you record expenses when you've incurred them, regardless of when money actually changes hands. Think of it like a scoreboard in a football game. The team gets 6 points on the board the moment they score a touchdown, not later on when they cash the winner's check. The event itself is what matters. So let's go back to our graphic designer. You finished the work in December, you sent the invoice in December, you earned that money in December. Under the accrual basis accounting method, that income is recorded in December, full stop. It doesn't matter that the payment arrived in January, and here we can really see the difference in the financial story these two methods tell. Under the cash method, your December might look like you didn't earn much, while your January looks fantastic. But was that the reality of your workload? No. The accrual method would show that December was a very productive month and that the January payment was simply a lagging indicator. It gives you a true snapshot of your business activity in a specific period. This brings up a crucial point for a sole proprietor or freelancer. The simplicity of the cash method is a huge advantage when you're just starting out. It's easy to manage and your bank balance directly reflects your books. But where it can be tricky is that it might hide underlying issues. You could have a month with 0 new work, but if 3 old invoices get paid, your cash basis books look great. You might not realize you need to hustle for new clients until your cash flow suddenly dries up. The accrual method, on the other hand, would have shown you that dip in earned revenue right away, giving you an early warning signal. So, to wrap this section up, the key takeaway is this. Cash basis tells you about your cash situation. Accrual basis tells you about your business performance. Neither is inherently better. They just tell different stories, and the right one depends on your business. Now, I want you to make this concept tangible for yourself. Here's your call to action for this segment. Pull up the last invoice you sent out and the last bill you had to pay for your business. Now, just ask yourself this simple question. In which month would this transaction be recorded under the cash method? And in which month would it be recorded under the accrual method? Go ahead, pause the podcast if you need to. Just doing that simple exercise will make this whole concept click in a way that nothing else can. Okay, I hope that little exercise was enlightening. Now you might be sitting there thinking, you know what? The simplicity of cash basis accounting sounds perfect for me. And for many service-based businesses, it absolutely is. But before you make your final decision, there's a single factor that can change everything. A real game changer that often makes the choice for you. And that factor is inventory. If you sell physical products, the IRS has some very specific rules we need to talk about, and that's exactly where we're headed next. Stay with us. Okay, let's get right into it. The single factor that often dictates which of the business accounting methods you have to use is inventory. That's the first key point. If you sell physical goods, whether it's handmade jewelry on Etsy, t-shirts you designed, or books you're reselling on Amazon, the IRS has specific rules that you absolutely need to know from day one. Think about it this way. If you're a new e-commerce owner, you buy products, you hold on to them, and then you sell them. That stock of products is your inventory. This simple fact forces a more formal approach to your bookkeeping right from the start, because you have a physical asset whose value is tied directly to your ability to make money. It's not just about tracking invoices, it's about tracking stuff. So, what exactly is inventory accounting? It sounds intimidating, but the concept is actually pretty logical. In general, the IRS says that if you have inventory, you must use an accrual method. Why? Because it's all about accurately matching your costs to your revenue. Here's a real-world analogy. Imagine you own a small bakery. In December, you get a great deal on flour and buy 1,000 pounds of it. You've spent a lot of money, but you've only used 10 pounds of that flour to bake the cakes you sold this month. The accrual method says you can only deduct the cost of the 10 pounds of flour you actually used against the sales from those cakes. You can't just deduct the cost of all the flour to make it look like you didn't make a profit in December. That's the core of inventory accounting. Matching the cost of the goods you sell with the income you make from selling them. Now, I can already hear some of you thinking, oh, great, I just started my little Shopify store, and now I have to use this complicated accrual method. Well, hold on, because this brings me to the most critical point, the small business exception. This is a big one. The IRS knows that forcing every tiny business to use full-blown accrual accounting can be a heavy lift. So they created a rule that allows many small businesses to still use the cash method even with inventory. So, can a small business use the cash method with inventory? The answer is often yes. The IRS has guidelines, which you can find in resources like Publication 538, that basically say if your business's average annual gross receipts are below a certain threshold, and it's a pretty generous threshold, you may qualify for this exception. This is a game changer for so many new entrepreneurs, simplifying their bookkeeping and their business tax return significantly. And finally, that brings us to point 4. Why does this rule even exist in the first place? It really comes down to preventing businesses from playing games with their taxes. Let's go back to that bakery. Imagine it's December 28th, and you've had a fantastically profitable year. You're looking at a big tax bill. A sneaky person might think, I know, I'll spend $20,000 on inventory, flour, sugar, everything, right now. Since I'm on the cash method, I can deduct that huge expense this year and make my profit look tiny. The IRS rule is there to stop exactly that. It ensures that your reported profit for the year is a true and fair reflection of your business activity, not just a reflection of a last-minute shopping spree to lower your tax bill. So, let's quickly recap. First, inventory is the big deciding factor that often pushes businesses towards the accrual method. Second, this is because inventory accounting is all about matching the cost of your goods to the revenue from their sale. Third, and most importantly for many of you, there is a fantastic small business exception that might let you stick with the simpler cash method. And finally, this rule exists to keep the financial picture fair and accurate. This brings us to your action item for this segment. It's simple, but it's so important. If your business holds any kind of inventory at all, your action item is to open up your web browser and do a quick search for IRS Small Business Inventory Exception. Just read one or two of the top articles. You're not trying to become an expert. You're just trying to see if this important rule might apply to you. It could save you a ton of time and complexity. Now, whether you're using cash, accrual, or the small business exception, there are some universal rules of the road that apply to everyone. Your accounting system has to be clear, it has to be consistent, and your books have to match your taxes. So what happens if you pick one method and later realize you need to change? That's what we're diving into next. Stick around. What if you don't have inventory? Or what if you do, and you've made your choice between cash and accrual? Well, you're not done yet. Picking your method is like choosing the type of car you want to drive. Now we have to talk about the actual rules of the road, the golden rules that apply no matter what you've chosen. We'll now cover the non-negotiable principles that will keep your small business accounting clean, compliant, and most importantly, useful for you in the long run. Okay, golden rule number 1 is all about consistency. The IRS puts it simply, your system must clearly and consistently show your income from year to year. Now, what does being consistent actually look like day to day for a freelancer or a new business owner? It's more than just ticking the cash method box once. It's about creating a habit. Think of it like a recipe. If you want to bake the same delicious cake every time, you use the same ingredients and the same measurements in the same order. In your business, if a client pays you a 50% deposit up front, you have to record that deposit the exact same way every single time. If you buy a new piece of software, you have to categorize that expense the exact same way every single time. This consistency is what turns your financial data from a messy pile of receipts into a reliable story about your business's health. Without it, you're just guessing. This brings us to golden rule number 2, and it's a big one. Your books must match your taxes. This sounds so obvious, right? But you'd be surprised how often people get this wrong. The accounting method you use in your QuickBooks, your spreadsheet, or whatever system you have for your daily bookkeeping must be the same one you use on your official business tax return. Here's the trap. A business owner might use the simple cash basis accounting method all year because it's easy to track money in and money out. But then, at tax time, their accountant might say, hey, if we filed using the accrual method, we could shift some things around and lower your tax bill. That is a huge red flag. You cannot have a split personality for your business finances. Your internal records and your external reports have to be speaking the same language. It's a foundational rule of compliance. So, what if you're a multi-talented entrepreneur running more than one business? That leads us to golden rule number 3. You can use different accounting methods for different businesses. Let's say you're a graphic designer who also runs an Etsy shop selling vintage posters. Your design work is a service. You send an invoice and wait to get paid. The cash method might be perfect for that. But your Etsy shop has inventory, those posters, which means the accrual method is probably a better, if not required, fit. The IRS is totally fine with this. You can use cash for the design business and accrual for the Etsy shop. But, and this is the critical part, you must keep complete and separate books for each one. Think of them as two different people. You wouldn't mix up their diaries, and you can't mix up their bank accounts, their expenses, or their income. Each business needs its own clean, distinct financial story. All right, our 4th and final golden rule tackles a very common fear I hear from new entrepreneurs. Am I stuck with my choice forever? And the answer is no, you're not. But, and it's a big but, you can't just flip a switch. Once you file your first tax return using a specific method, that method is considered adopted. If you want to change it later, you generally need to get IRS approval. This is not a casual decision, it's a formal process. So, when might you even want to change? Let's think about some growth milestones. Maybe you started as a solo consultant using the cash method and it was perfect, but now your business has grown. You've hired a team, you have significant accounts receivable, and maybe you're seeking a bank loan. Suddenly, the cash method doesn't give you an accurate picture of your monthly performance anymore. Lenders and investors want to see the more formal, accurate picture that accrual basis accounting provides. That's a classic signal that it might be time to switch. If you find yourself in that spot, the search term you'll want to remember is how to change accounting method with IRS, as they have specific forms and procedures, like Form 3115, to guide you. The key takeaway is you have flexibility, but you have to follow the formal procedure. So, to recap the 4 golden rules for any of the accounting methods you choose. 1. Be consistent in how you treat every transaction. 2. Ensure your daily books match what you report on your taxes. 3. Keep your businesses financially separate if they use different methods. And 4. Know that you can change your method, but it's a formal process with the IRS. These rules aren't here to make your life difficult. They're here to build a strong, stable financial foundation that you can rely on as you grow. And that brings us to your final action item for this whole episode on cash versus accrual accounting. I want you to open your bookkeeping software or your financial spreadsheet right now or as soon as you can. And somewhere in a notes section or right at the top, I want you to formally write it down. Something like, this business officially uses the cash or accrual method of accounting as of today's date. That's it. By putting it in writing, you are committing, You're drawing a line in the sand. This simple act will help you build the consistency we talked about and give you the clarity you need for long-term success. And that brings us to the end of our deep dive into one of the most important decisions you'll make for your new venture. So, let's quickly recap what we covered today. We started by establishing why choosing from the different business accounting methods is a foundational decision you make on your first tax return, not just a casual choice. Then, we demystified the big one: cash versus accrual accounting. We saw how cash basis accounting is all about when money changes hands, while accrual basis accounting gives that more formal picture of your financial performance. For me, the most critical takeaway, especially for anyone selling products, is how inventory accounting can be the deciding factor, often pointing you directly to the accrual method. Understanding that rule alone can save you so many headaches and is a cornerstone of good small business accounting. We also touched on the importance of consistency and the formal process for changing your method if your business grows and your needs change. Ultimately, this is a perfect example of what we stand for here: understanding your financial choices to seize financial control. Thank you so much for joining me today and for being a part of the Safe Simple Sound community. I truly appreciate you tuning in. If this episode helped you, please consider subscribing so you don't miss what's next, and be sure to check out our show notes for links to the resources we mentioned. Join us next time as we tackle another crucial topic for new business owners. Until then, stay informed, stay empowered, and keep making sound financial choices. This is Alex signing off.